Well, of course, the macro cues, and you would have seen what's happened today. The rupee, for example, is strengthened for a second day on a trot. It's the best performing Asian currency today. And it's good going all around. I think the bond yields too cooled off a little bit, a wee little bit from the highs of the day as well. So that probably is a good sign too. It's the rupee is, of course, the highest since November 20th. I think the Iran nuclear accord, what's happening with crude, etc., so on and so forth, all of that really helping the currency to do what it is doing in trade today. Of course, lots of important things to watch out for the day and the week as well. For the day, of course, there will be the cabinet, which, of course, the news bits now coming that the decisions may not be taken today, but probably will happen during the week. End of the week, we have the GDP data as well that is going to come out, and that will have some bit of bearing as well on the market sentiment. So all in all, an action-packed week lined up in this week. Both on the macro as well as on the equity markets front, because, well, it's the FN expiry and that will keep the equity markets interested. But let's get in the opening views from Maithili Busnurmat. As I said, she joins us right now on the show. Maithili, good having you. Thanks for joining in. Lots to watch out for. One, what's happened over the course of the last 1 week with the Chinese reforms and people talking about the fund flows. Two, the global comments. And three, our own GDP data slated to come out end of Friday.
Absolutely. I think for the moment we've got a temporary respite thanks to the Iran deal, which is why we're seeing the rupee strengthening. But that only makes it even more puzzling why the RBI has chosen to roll over the swap for the oil marketing companies, because frankly, if the rupee was strengthening, there really is no case, unless the RBI is also aware, perhaps, that the second quarter GDP numbers that we're going to see on Friday will not be very cheerful, in which case the strengthening of the rupee that we're seeing now might turn out to be very transient, very temporary. So it will be interesting to see what the GDP numbers that we have for the second quarter that come out on Friday. Of course, third quarter numbers are expected to be better, but if the GDP number for the second quarter is below 5, that makes it that much more difficult for the country to really achieve the 5% to 5.5% that the finance minister has been talking about for the year as a whole. So I think all eyes will be on the Friday numbers, but for the moment we've got a respite, which, as I said, only makes it even more puzzling why the RBI has opted to roll over the swap windows. Presumably, they think that the GDP numbers will not be too cheerful, so it is better to play safe and roll over the swap window for the OMCs.
Let's also bring in Amandeep Chopra, Group President and Head Fixed Income, UTIMF, who now joins in on the show. Amandeep, let's start off first and foremost with the way the rupee is panning out. It's clearly that breakthrough in the Iran nuclear deal, RBI's move also to extend the special forex swap window till the 31st of December, that seems to be propping up the currency. What's your view as to how the currency is likely to trend from here on?
We are looking at rupee largely being range bound. I think it's true that it has factors which will both lead to slightly depreciate. You still have a little bit of the oil and marketing companies FX buying to come into the market. So I think that clearly will be a little bit of a negative. But if you look at most of the foreign institutional flows, they've been quite positive and quite strong. So I think that's been one big offsetting factor for the currency to depreciate. The other factor clearly has been that exports have picked up and our trade deficit numbers are far better than what they were a month ago. So I think those are the two big positives, which is keeping rupee sort of on a slightly appreciating bias. So I think on the whole of it, you will see rupee being range bound, and I think the range is very clear. It's between 62 to 63 in the immediate term.
Amandeep, do you anticipate the RBI extending the swap window also for the FCNRB and for the Tier 1 capital of banks, because they've done it for OMCs, so why not for the other two legs as well? But unless you assume that they feel that they've got enough, they've already supposed to have got something like 22 billion through these two swap windows. So do you think they're going to extend those facilities also, or will they feel enough is enough? Because these swap windows do have a cost, so that the RBI has been saying that there is no cost really.
Well, there is a cost definitely. So I think you have seen a little bit of change in terms of not strictly extending the window, but permitting committed money under this same FCNR deposit scheme to come in as long as the funds have been committed till the end of this month. So they can actually flow in well up till the end of December. I think from RBI's perspective, clearly they need to shore up their FX reserves. Tapering issues again come to the forefront, and one really doesn't know whether it will be between December and Jan or between Jan and March. So I think irrespective of what people may feel that the tapering will really not have a significant impact on the Indian markets, I think it will. So clearly from that perspective, RBI needs to shore up its FX reserves, and they will look at all means to ensure that they have sufficient buffer available in case you see relatively sort of negative impact or pressure on the currency.
You spoke about tapering. The next FOMC meeting, which is supposed to perhaps discuss the tapering, is on the 17th and 18th of December. The RBI's mid-quarter review is also on the 18th of December. Given the time difference and given the fact that in the previous mid-quarter review, the RBI had postponed its review till after the Fed's decision was known, do you anticipate that happening again?
Very unlikely. Not in our view. I think this time, since FOMC has more or less made its view very clear on both tapering and the the extended pause as far as any tightening bias is concerned, I think RBI is unlikely to really change the date of its own mid-quarter review meeting.
As far as the yields on government bonds are concerned, we saw the yield coming down. Last auction was 8.83. Do you think that's again a temporary respite, and will yields again go up? Especially because there are some reports that the government is thinking of increasing the payouts under the Manrega scheme, in which case there's just no way the government will be able to abide by that 4.8% of its GDP for the fiscal deficit target. So is that just a brief respite at 8.83, and will yields again go up to beyond 9%?
Well, Ivan, if you really look at it, the yields have really backed up quite significantly, and that's largely been on the backdrop of relatively bearish sentiment. You saw very poor inflation data which came out 2 weeks ago, and also there's been a significant amount of supply of new government bonds in the current month. So I think both technical and a little bit of fundamental macro data has pushed the yields back up significantly. The concern for the market currently clearly is that the RBI is not really intervening in the market through open market operations, which was something they had done just about a week ago. The new 10-year issuance clearly was well bid, and as is typically natural for the market, whenever a new security comes into the market, you generally see good volumes, you see it pretty well bid. So the decline that you really see in the new 10-year is more driven by the fact that there is limited supply. You just had the first auction, and there is going to be significant demand simply because every trader and investor would want to have a small exposure in the new bond. So I think that's what has that is the reason which has sort of driven down the 10-year yields. If you look at the old 10-year and some of the other liquid securities, the spreads that they are currently trading at over 30 basis point is fairly significant. So I think a lot of negativism is already being built into those yields. From our perspective, I guess, if you look at over the next few weeks, there are very few triggers other than the fact that December relatively has fewer auction supply coming into the market, and then of course you have the mid-quarter review. I think both of them will really set the tone for the next movement in the yields. Currently, the markets, in my view, are fairly oversold, and you could see a positive bias as far as the yields are concerned.
Just a couple of questions actually, and we'll come to the commodities bit as well with you, Maithili. But Amandeep, just wondering, you gave a brief answer on the currency. Do you believe that with the oil marketing companies' demand back onto the window and the fact that the month end is approaching, we may see some pressure on the currency, never mind the strength that we've seen today?
Fair enough. I think that's the reason why I mentioned that you could see Rupee trending marginally above 63 as well when the the complete demand from the oil companies really comes into the market. Again, it's not certain that whether all of it will come in. Clearly, the central bank will be looking at the currency exchange at that point in time. And like I said, there are certain other mitigating factors. Jan to March period is also a period where you see significantly higher export growth. And I think if that were to ensure that your trade deficit remains low, then possibly some of this oil demand could come back into the import bill, and you could see a little bit of sort of counterbalance coming in. So I think on the whole of it, you could see a marginal depreciation in the currency. But like I said, there still are a few mitigating factors. You are seeing a sharp reduction in precious metal imports. You are seeing a general overall growth taking place in most of the developed economies. So that is positive for our exports. And the currency depreciation over the last 3 months clearly has helped our exports. So if we maintain that momentum on the export growth, I see no reason why some of the oil demand does not come back into the market.
Amandeep, just to deviate from that and talking about what brokerages as a whole make of the India macroeconomic story, and some believe that as a longer term theme, China's re-rating is likely to steal the limelight, and they maintain a fairly neutral stance when it comes to the India growth story. What do you think would be a game changer when it comes to brokerages now revising their stance on the country?
So I think clearly the big concerns as far as brokerages are concerned clearly seems to be on the on the poor policy implementation. I think that will be the significant game changer as far as India is concerned. If you recall, even the Chinese story, which is again come back in the limelight, is again based on reforms in the areas which typically were sort of not looked at very closely by the state over there. So I think from India's perspective, the story which will sell in 2014 and well beyond 2014 will be one of reforms. Reforms which have largely been stalled or have really not taken off over the last 2 years. And again, in terms of some of the policy, I would say impetus which is required to ensure that we again get back to the growth path. Clearly the GDP data which is coming end of this month, end of this week specifically, is going to be very poor. And in that backdrop, it becomes very difficult for global investors to really look at a country which has sort of an economy which is slowing down, and and very few steps being undertaken to bring it back into a growth path.
Amandeep, if you remember when the new RBI governor, actually he's not really new anymore, but when Dr. Raghuram Rajan took over in September, he had clearly stated that the RBI would be issuing inflation index bonds, indexed in fact to the CPI, because that was what was more relevant. And he said end November. But we have no further news about that, and we're now seeing a fresh issue of WPI-linked inflation index bonds. Is the RBI having second thoughts? Is it getting cold feet because it knows that if it issues CPI index bonds, the rate of interest would be much higher? What's your take on that?
I think from RBI's perspective, if you remember, they have set up a committee to look into sort of a harmonization of the inflation indices. I think until that report comes out conclusively, it will be very difficult for them to benchmark their inflation index bonds to a specific benchmark index. So I think from our perspective, clearly WPI, while it has seen some amount of appetite, is not really the best of inflation index bonds for the retail investor. You're right. I mean, CPI clearly will be much more attractive, and given the current high CPI rates, there could be a thought that this may not be the right time to launch it either. So I guess it's a combination of both. You do need the committee which has been set up to look at the inflation index to come out with its report. And as you're aware, even the central bank itself wishes to move towards, looking at the consumer price index as its benchmark for monetary policy decisions rather than the wholesale price index currently.
Maithili, just one question to you on whether you believe this the Iran deal can have far-reaching or a larger or longer time period impact on crude prices. They are down 3% today, yes. But previously we have seen when sanctions were removed from Iran as well, or Iraq as well, the impact was staggering, 25% at one time, over 30% another time. Do you think something like this could happen this time around as well to crude prices over the period of the next 1 year?
Well, it is a little difficult to say because the devil really lies in the details. We don't have too much of the details available. But my sense is that even if, it takes some time and oil prices do react and fall, I think India will gain, because if the sanctions are removed, we will be able to buy more oil from Iran through the rupee trade. And that, I think, will be hugely positive as far as the forex market is concerned. So for us, I think we have two things to watch out for. One, what does it mean in terms of international oil prices? How much do they fall? And even more important, whether we can buy a larger part of our oil from Iran through rupees, in which case that will really help our forex market.